Chuck's question. Chuck had asked me about, is there a way to list all of the symbols where the IV rank is above or below some value? Just one instance per symbol. I can see searches for implied volatility on PowerOptions, but not IV rank. Okay, IV rank is a very popular thing as discussed, the implied volatility rank. Where's the stock's volatility now compared to where it has been? We prefer to use something different on PowerOptions, Chuck, and you can find it in the single option strategies. I know you prefer to look at spreads right now and some of those different ones. I don't think it's in the calendar call, but I'm going to check. But it gets complicated if you're just looking for a list of symbols here. So we do have the sell implied volatility range and diagonals and the buy implied volatility range. I just don't think it's available at this moment in standard credit spreads or debit spreads. I'm going to take a look, see if they added it. No, we just have the implied volatilities. But to answer your questions, you can do that. We call it the percent IV range. And so I might just use a single option strategy. I don't want to mess around with the diagonals because that gets a little complicated. So I'm just going to use long call to keep it simple. Let me remove strangle. And I'm going to add in the long call. And what I want to do for Chuck is I'm going to create a search that, let's say, just shows me the total number of symbols where the IV range is greater than 80%. The percent IV range. Now, our percent IV range relates to the option, the specific option you would buy. But if an at-the-money option on a stock for December expiration is near the 80th or 90th percentile of its implied volatility range, it's likely that all other options in that expiration would pretty much be near the same price. It's inflated for a reason. Here's how I would create your search. Either way. First, single option strategy. This even counts for covered calls, naked puts, and so forth. But let me just clear the filters. I'm going to empty everything out of our parameter field that's underneath the results. The results, of course, came up based on the default search that was there. For long calls, we start you off with two searches, the Bollinger Band screen that Ernie and I would start off with if we were buying long calls today. And there's a basic initial values one as well. But I'm going to clear everything out. I'm going to click on standard expiration for December, Chuck. Why? Because every option stock, every optionable stock, ETF, and index has a standard expiration. I'm going to limit the strikes to be one out of the money, 1-to-1. What does that mean? Number of strikes, your steps on a ladder. Our example of Apple at 265. One strike out of the money would be the 270. Two strikes would be the 275, assuming it doesn't offer dollar point strike differences or 2.5. By limiting this to 1-to-1 out of the money, I'm only telling the system to identify one strike that is just out of the money for any stock. So we won't see duplicates, as you mentioned. Now, the percent implied volatility range, I want it to be greater than 85. So I'm only looking for that sort of at or just out of the money option on any stock where the implied volatility range, where the option's current implied volatility right now is within the 85th percentile of the entire range of the option since it's been released on the market. So through all the conditions that have happened, fluctuations, but that's what it's looking for. Where is the IV of the option now compared to where it has been over the life of the option? I see 121 stocks where the December expiration series has implied volatilities that are up above 85% or higher of their total range. And you see it here. I've added this column in here. I'm going to add another column in just a second, David, to help us see this a little bit better. Okay, so we've got implied volatility ranges 94, 100, 87, Autodesk, Hallador. I'm looking for, I saw a common one here, Lakeland Industries, Advanced Disposal. This is just the first page, Guess as well. Okay, they're at 100% of their IV ranges. Maybe they had earnings. Now this one still has earnings 11 days away. I have that column added as well. But one thing I want to mention, and this is even needed to mention if you're looking at a stock volatility range. If you have a stock that's at 90% of its historical volatility range, this 50-day or 20-day volatility, you still have to stop in a moment and compare it to something. You almost have to take this IV rank and this IV range with a grain of salt. Why? Because let's take a look at Hallador. Now it's a low price stock. Let's take Autodesk. It's known. It's at 161. That just out of the money 165 call for standard December expiration is currently at an IV of 0.3687. We're in 87% of an IV range. However, if the actual true range of implied volatility for this Autodesk 165 call is only 0.34 to 0.37, this 87 percentile of where it is right now, well, yeah, it's above the low, but is this really a wide enough range to say that, yes, this is extremely overvalued? Not really. Okay, so to clear things up, what am I going to do? I'm going to go to Add to Remove Columns. Anything I can search by in any of these strategies in the parameter field, I can view as a column, plus additional ones as well. I want to go to the Options column. I've got my implied volatility already set. I've got the percent IV range already set. Oh, sorry, folks, the IV over HV. But the one thing I also want to see, if I can do it here. Come on, come off. It's not letting me. Let me refresh that. Oh, there we go. Okay. I thought there was a field on this one for the actual. I'm looking for it. I apologize. There's a field on a lot of these. I think it's actually not on long call. I'm surprised. I thought it was here and I used it last week. I must be mistaken. My apologies. But in addition to the percent implied volatility range, I want to see the actual range. Okay, so I'm sorry. I thought it's not here in long call. It must be in that calendar one. We were looking at it last week. So real quick, what I do is that, yes, I see I'm at the 87 percentile of my IV range. The current implied volatility is 0.3687. So I would just quickly go to Research, Option Research. This is actually pretty good. There's my implied volatility. There's my IV range. And here is my actual implied volatility range, 0.277 to 0.3828. So yes, with this high range, if I sold this option, I'd hope that in some near term it's going to revert back to the norm. That decay would work in my favor. However, this December option with this high implied volatility range, and it does have a IV over HV of 1.4, meaning it's roughly 40% overvalued compared to its historical stock volatility, the current IV is. Well, the reason why is because it has earnings coming up in 11 days. I'm not sure if this is something that I want to be selling, because if the stock tanks, that could cause me a lot of problems with this potential naked call. Okay, so the theory there is that if I have something that has a high implied volatility range, and I have something that does have a high IV over HV ratio where it looks like it's 38 or 40% overvalued, there's probably some event that's causing that to happen. And if I just sold this naked call with earnings coming up in 11 days and I'm 35 days out, if the stock gapped up high in price, I could be in a lot of trouble, be at a high risk. Okay, so it's not always a great idea just to sell premium. Remember, you still want to be in some sort of hedge when you're going into the earnings position. The reverse, Chuck, you want it to look for something that's in the lower range, just change it. Instead of looking for an implied volatility range of greater than 85, and I might save this. I might save this as static OTM search high IV range. Okay, so I'll save that search in my long call or for using the naked call screen so I can always come back to it. I'm still going to say one-to-one out of the money, but we're going to reverse it. Instead of looking at an implied volatility range greater than 85, let's look for less than 15. And there we go, Freshpet, VSAT. Wow, 2% implied volatility range. Undervalued compared to the historical volatility with a current IV of 0.2232. USA Technologies, wow, that has an implied volatility of 100, 101. But it's at 11 percentile. This thing must have been around 200 at some point. Fantastic range. Scary, but fantastic at the same time. So these are the ones that have that lower percent IV range. And you see a lot of them with high numbers, which means, you know, IM Gold, Zoom Video, they must have had an implied volatility of around 100%, 140% at some point or another. Now they're back down to their lower range. They could still drop lower. You'd have to do further research and analysis. But again, I've saved that. It's my new static search. So instead of static OTM search high IV range, I'm going to change this one to static OTM search low IV range. Now on my long calls, I can come in and see whichever, oops, a little bit too many, 600 results there in the low implied volatility range. Naturally, I'd put in other criteria to trim this down. We're just showing this straight example. Now in that drop down below the listed trades, I'm in my long call search. I can just toggle between those two or any other stocks that, any other saved searches that we have for this particular strategy as well. Okay. And I think I answered this question, but I didn't answer it directly from Mark. Mark says the power options percent IV range, that's true that it only looks at the life of the option range, not over the whole year of IV rank. That's correct. We feel that's a better measure. You can disagree with us on that, Mark, and that's perfectly fine. But rather than looking at a whole calendar year where the beginning of January was a completely different market than what we're looking at today, when April and May were a completely different market than we're looking at today, we're looking at the static life of the option from when it was released and how that option reacted itself rather than, see, for example, let me go back to the long one. I'm sorry, I forgot that. High IV range, I'm sorry, not the long one. Let me go back to the high IV range there, Mark. And let's look at Autodesk again. I want to go to research, and I want to go to options research. Now, this might be one of the examples that bites me in the eye, but here's the problem. For this particular option series on Autodesk, the December series for Autodesk, it wasn't one of the ones that always had December options. This December series I'm looking at only came out after October expiration. It's only been available for 3 months. What good, this is our personal opinion, Ernie and I both feel this way, not saying that you're wrong looking at it the other way, looking at it over a calendar year, but what good does it do me to compare this particular option on Autodesk that has only been around since October to what the market as a whole in Autodesk was doing 8 or 9 months ago when this option wasn't even released on the market? That is our opinion. We might be a little bit jaded in that, but that's what we feel, is that this option wasn't even on the market. Autodesk was at a completely different price. We want to look at for something that if I'm looking at a specific strike to buy or to sell, I want to see it over the life of the option. And yes, I see it's been out to October, so I would look at Autodesk's chart over that 3-month period and say, how did this IV react? No, I'm sorry, I'm on the wrong one. It's the red line. How did this IV react when the stock shifted one way or the other? It's been pretty static. But does it do me any good? You obviously have a different opinion, Mark. But does it do me any good if I'm interested in buying or selling or including this December 165 strike as part of a spread for trade the next 35 days out? Does it do me any good to consider where the implied volatility of a 165 strike was for a different expiration 8 months away, 8 months ago, or over a 12-month period when this option hadn't even been released on the market? So that's our thoughts on it. That's why we use the percent IV range personally, rather than the IV rank that looks over a static 12-month period. And it's also kind of confusing too, because when you're looking at leap options, if I was looking at a January series right now for Autodesk, let's just go to the option chain real quick. Subtle argument that we can go back and forth on, I know. But if I was looking at the January 2020 strike, somewhere, let's say the 160 or the 165, again, as to sell or as to part of a spread, I go to research and I go to call or to put research in that case, builds this up. I know it's hard to see. This goes back to September 12th or 11th. I know it's hard to see, but the full range goes back to November 11th, 2017. That's about 2 calendar years, isn't it? This option has been around for 2 years. Just using the IV range, as you mentioned, looking at 1 year, I'm cutting off half of the known data for this leap option because it's been around for 2 years. Naturally, of course, I agree that's going to smooth some of this out because it's got so much more extra time. But really just that one static year. This option's been around for 2 years. The IV range we show is for this full 2-year period that the option has been, this particular option has been on the market, not just 12 months back. Okay, so yeah, and it's smoothed out a little bit, but the low over 2 years is 0.2972 to 0.4282. We're currently at, 28% IV range, with the IV currently at 0.33 as well. Okay, yeah. Okay, so, okay, and that kind of explains it. And I know I'd say that I know the gentlemen the gentlemen and gentlewomen who teach the IV rank. They're very respectable. They're very knowledgeable. Some of them more knowledgeable than me. Some of them much better traders than me. You know who I'm talking about. I don't name names. But they don't agree with this concept. They prefer to use the IV rank as they teach and they mention. And I'm not exactly saying they're wrong. It's just Ernie and I have our opinion that looking at the option over the entire life of the option rather than just saying, hey, 12 months, when some options have only been around for 2 months, think about weeklies. If you're trading a weekly series, the longest it's been around is for 6 weeks, not 12 months. It's an entirely different market. So I'm looking at it, what it's been over the life of the option entirely. In this case, we're looking at one that's actually been out for 2 years, not 12 months. All right? We're losing half the data by using that calendar 12-month. Those others disagree with me. Mark does add, I'm just saying this for, I always say I'm going to read everything that comes in. Mark said he's just checking to understand. He had not been exposed to the life of the option concept on IV statistics, so he doesn't have a real opinion yet. Okay. Well, I know Mark pretty well in the sense that he's here on Fridays, and I've talked to him at other times via email as well. And why I'm saying that is I know Mark's going to do his due diligence, and he's going to test me on this. He's going to start comparing his IV ranks and his IV statistics that he's come across versus how we're doing this. Over time, I'm sure Mark's going to let me know that, you know what, I found that the IV rank does work better for what I'm doing and what I'm looking for, an expected change compared to your percent IV range. Or he may come back and say the opposite in our favor. But I know Mark's always testing, always trying to improve, taking in some of my thoughts as well and taking in some of Ernie's thoughts and doing his due diligence constantly. So Mark will call me out on that at some point or another. Chuck does say he would be using simple long calls and puts. Great. So back to square one there. That's how you do it. This is your percent IV range you want to use. And you can also toggle it too a little bit, Mark, in the sense that you could say, look, if I'm looking for those ones that are in the high implied volatility range, well, I want to see something that is, at least has an implied volatility of 0.35 and also higher, that's moving more. So you could use those in combination as well. Okay.